Greetings, this is going to be our monthly inflation update, and I don't want to have too much repetition month to month about how to check these numbers, so I'm going to keep this on the shorter side in order to get more of a background on what the numbers mean in our methodology for evaluating what inflation actually is and what should and should not be included in inflation. Please see last month's video up over here, which is longer and goes into more detail. So as usual, we go to the bls.gov website for the US CPI index and click over here to this little graph icon. And so we have the CPI data over here, and therefore among formatting options, we choose the following: original data value, 1 month, 3 months, and 12 months. Retrieve data. So this is the absolute value of the CPI over 10 years, and yes, it's rising because the natural state of affairs is to have average inflation. 2 to 3% inflation. The steady state is not to have 0% inflation. That is too low. That is going dangerously into deflation, and deflation is much worse than inflation, as I describe in this video over here. However, we do have inflation, and it is actually kind of low. It's a bit lower than the ideal and has been for the last 10 years. So while people are screaming about this recent rise, where does that reside in the context of the entire long-term moving average? And to determine that, we have to look at the average inflation rate over the last 10 years. So to do that, we take this calculator and we take this number of the CPI, 274, divided by the number from 10 years ago, 227. 274 divided by 227. 1.207, which means the 10-year total inflation has been 20.7%. But in order to find how much that is per year, we take the 10th root. So we take x to the y power of 0.1. That is to show the 10th root of that number to get the annual compounded rate. I hope everyone understood the arithmetic of how that is. And there you have it. It is 1.9% a year. 1.9% a year, 1.01899, or 1.9% a year, is the average CPI increase rate over the last 10 years. This does not exclude food and energy. It does include food and energy costs. So 1.9% a year. That is in fact slightly below the band of optimal inflation, which is 2 to 3% a year. Now, as you can see from this 12-month percentage change, the 1.9% average that we see is kind of manifested, and it's a little high right now, but that's a very temporary thing. It's only offsetting the super low inflation from the early part of the COVID-19 crisis, and the average is still 1.9% a year. And this brief spike is already mitigating, and that's why I chose the 3-month moving average as well. This is the 3-month moving average. The spike that everyone was screaming about a couple of months ago, that's already dissipating. It's already getting down to the normal 3-month band, which is over here. So you can see it's going down. This scare of hyperinflation has already started to go away. And 1.9% a year has been the 10-year average, and you should always take a long-term moving average, like a 10-year average, so you're not swayed by all the short-term media hyping up of noise level data. Even on this channel, a number of commenters asked me, well, I heard somewhere in the media that inflation is really picking up. Really? Really? This is called picking up? It's already going down from that point. The average has been 1.9% a year. But this is the US CPI, and this is a US only figure, and money printing is worldwide, as well as technological deflation being worldwide. There are no borders to these things. Therefore, as always, we go to the Goldman Sachs Commodity Index to get the true measure of inflation, because that is worldwide, reflected in commodity prices, and therefore not riggable. A lot of people say that the CPI is rigged by the government to understate inflation. Well, the Goldman Sachs Commodity Index cannot be rigged because it is an index of commodity prices that anyone can buy. Anyone can buy oil or gold or natural gas at the prices that they trade at every day, and the composite of those prices represents the Goldman Sachs Commodity Index. So we go there. Goldman Sachs Commodity Index, 591. It's picked up a little bit in recent months, but does that really matter within the 10-year context? Sure, over 1 year it rose 63%. That's huge, that's huge. That is hyperinflation because it rose 63% in a single year. But what did it do before then? The 10-year average is minus 0.75%. That is deflation. The price is actually lower than it was 10 years ago. And this is a composite of everything from oil to gold to natural gas to all sorts of other commodities bundled together. The 10-year average is minus 0.75%. So while the CPI has risen plus 1.9% over this 10-year period, commodities have actually fallen at minus 0.75% a year for 10 years. That is deflation. Despite this little uptick because of all the various factors trying to push commodity prices higher but failing to do so, people are screaming about this, but unless you're looking at this 10-year chart, you're not getting a holistic picture of all of the data. And this is the way to look at inflation. Now, for all the people who are either predicting hyperinflation or even worse, claiming that hyperinflation is already here, but using weaker and weaker rationales to justify that, notably the Economics Explained channel, who I deconstruct in this video over here, all that is nonsense. We have exponentially rising technological deflation, and the money printing needed to offset that deflation is therefore also rising exponentially. And this is a good thing if it is recognized as such and recognized as a monetization of technological deflation for human benefit. And I wish more people could grasp that, but you have to have a very multidisciplinary profile of knowledge, and people who study economics just don't have that if they have a formal PhD in economics. They are very theoretical people. Their faith in their theoretical economic models from the mid-20th century is total, and evidence doesn't get them to change their mind, as we often expose on this channel. Now, as far as what level of inflation would be considered slightly high, see, I won't deny if there actually is high inflation. When that happens, I'll tell you if it's happening. But the amount of money printing and or bad government mismanagement needed to create that level is much higher than it is now. Bad government management being the bigger factor of the two in that scenario. So unless the CPI index's 10-year average is 3% a year, above the 1.9% that we just saw, 3% a year, and the 10-year growth rate of the Goldman Sachs Commodity Index, which we're looking at right now, is also 3% a year on the positive side, meaning it's green and plus 3% a year. Until both of those things happen, don't worry about inflation. You should be more worried about deflation, and how the very, very misguided approach from the Federal Reserve to actually end quantitative easing and raise interest rates, despite there being no reason for them to do that at all, is going to cause deflation, which then means they'll just have to print more later on anyway. So until the CPI is plus 3% a year, and the Goldman Sachs Commodity Index at the same time is also at plus 3% a year, over a 10-year moving average, I don't care about short-term fluctuations, 10-year moving average, only then should you actually worry about inflation starting to get a little high. It's still not at a problem level yet at those thresholds, but that is when we should say, okay, maybe things are edging a little high. Until that happens, I will not say that inflation has any risk of being very high, and the threat of deflation is in fact the thing to look at, because that's what no one is looking at all. So this video was perhaps a little bit longer than I originally intended, but I hope that you nonetheless found it to be very informative, and thank you very much for watching.